Okay, so Clint and Jaden, thanks for joining us for the quarterly Fireside Chat. Jaden, I might start with yourself. Um, where do you want to start? New central banker,
Yeah.
the new Fed, the new chairman of the Fed. Will he be more successful than the previous ones?
It's still, markets are very unsure about that at the moment. There's a few reasons for that. When Warsh came in, there was a pretty strong narrative that Trump was going to appoint someone that wanted to cut rates, or at least had a cutting bias. And that hasn't played out at all because US inflation is so elevated, largely due to the Iran war, which caused a re-escalation point for a lot of energy prices, and that feeds through to the rest of the economy. So that's problematic for the ability for the Fed to cut rates. But it appears that Warsh knows this. So I'll step back a bit. When he came in, one of the things he said he wanted to do, what he started to do, is readjust how the Fed communicates externally. So predominantly on how much communication they give out outside of rate decisions, and then a sort of guidance that they give for those rate decisions. So in his first meeting, which is a couple months ago now, he abstained from voting the dot plot, and the dot plot's where each individual voting member points out their expected forward path for rates. And so he abstained from voting which was a clear message that he will get rid of the dot plot in the coming months. And we're starting to see the impact of that. And so markets are really unsure how to read this new environment where we don't have guidance. And so we had another Fed meeting the other week, and Fed was on hold, but post the press conference, markets got really jittery about what this new lack of communication means, how to read the new Fed, and they pushed yields much higher. So the 30-year yield has reached 20-year highs in the US, largely on this uncertainty piece. And so there's an argument to be had that this is actually intentional, because Warsh knows that they've got an inflation problem in the US, but he also knows he can't cut rates for fear of pissing off his appointer. So this actually could be an incredibly intelligent play, or it could be that his communication is actually working against him and that it's pushing up yields. So it's a bit early to say, but pushing up yields, while not good for the US government, would be good for inflation. The market's doing its job of enforcing rates. So it's driving a lot of markets. It's just another piece of uncertainty in quite strange times in markets. But that's been big story this past month.
Yeah, I guess the thing is with the bond rate at the level that it's at, when it's got up towards this sort of level previously, things have started to break. So we'll see how he goes. If something breaks, he'll throw everything but the kitchen sink at it, I'd suggest. The Middle East, the war that's on again, off again, sounds like it could be an episode of Friends or something like that. What's the latest? I don't even follow it these days.
Yeah, the narrative changes pretty regularly, and there's always some sort of rhetoric that's either inflaming or doing the opposite, right? So the rhetoric's moving much quicker than the conflict itself. It's clear that the US is constrained now by weapons capacity, and Iran knows this, so Iran's been able to play this leverage point pretty consistently. And again, in the last couple of days, I had more commentary out of the US that they're out of key missile supplies that they would need to continue the conflict in Iran. And so a couple of weeks ago, Trump had said that he was going to ramp up and have a big escalation point in the conflict and start a big campaign. But his advisors came in and said, look, we actually don't have the weapons to do this. We can't do it. And it just highlights that the amount of money and weapons that have had to go into this conflict, in some ways to keep the Strait open and the Strait opening and closed, just the volume of weapons and the fact the US hasn't been able to manufacture them over the past 12 months quickly enough to keep this going, highlights the constraint. So we still don't think this goes on forever. We think there is a stopping point for this. We think the constraints are very strong, and we're starting to see that now. But it does mean that oil prices still stay elevated, so we won't get back to where we were in March. I don't think the current price, I think it's around $100 a barrel at the moment, is likely. I think it's come off a little bit since then over the weekend and to today. I think that will start to ease off, but we won't get back to the pre-war $65, $70 a barrel it'll stay elevated. And so many countries have to rebuild reserves, especially Japan and the US, because they've eaten so much into strategic reserves over the past 4 months since the start of the conflict.
Yeah, absolutely. Well, the people that were paying attention knew that the US were actually running out of weapons in the Ukraine. Right? So this all happened after that. So I dare say the Iranians and the Chinese, dare I say, they're well aware of what's going on. Okay, so I guess probably the big movements in markets is probably the recent sell-off in Korea and tech. So just talk us through that, what actually happened, and what does that mean moving forward?
So semiconductors broadly sold off. So the index is down a bit over 20% in July, which is a pretty severe sell-off. And then some names were down much more aggressively. So SK Hynix and Samsung, the two poster childs for the Korean index and Korean semiconductor and memory industry. SK Hynix is down 42% from its peak, and Samsung is down about 30%. I mean, they're both still up over 100% year to date, which just shows how strong that rally's been this year. And then SanDisk was down 38% from its peak. That's still up 420% year to date. So still incredible numbers, but a lot of profit taking. And so the narrative shifted. The last few months we've been talking a lot about how the hyperscalers are making huge commitments to spending and how sustainable that could be. Now we're starting to see the impacts of that, where investors are starting to question that more seriously, and they're having to say, okay, maybe we should soften our approach. So even Alphabet, owner of Google, last month, they had quarterly earnings, and they posted their first negative free cash flow number since listing in 2004. And so the market environment's changing, where all of this money is being spent on AI. Investors want to make sure they see a return for it. So as any investor applies pressure to the hyperscalers, once that narrative gets out, all the flow-on effects, mainly to memory and chip companies, they feel like they're going to get less dollars. And so even Samsung, SanDisk, SK Hynix, their prices actually went up during the month, but there's just so much hype and optimism in these names that it doesn't matter that they all had record earnings, really good fundamentals, but the valuations here are just so beyond reason that none of it mattered, and they all fell between 30 and 50%. So that's really the narrative here. The models, I think one of the other things that's happening in hyperscalers is not just investors are concerned about their ability to spend the money, but it's also that they're getting more and more competitive. So there's another Chinese model that was released a couple of weeks ago, Kimi K3. Chinese models are mostly open source, meaning you can download the model and run them yourself. So a bit different to the way the US models work. But it also means that they're gaining a lot of traction pretty quickly in commercial applications because they create them as open source models. But the Chinese are focused on keeping up with the US for doing it much more efficiently. That's not good for the semiconductor manufacturers. And it also means that as more and more of these models are becoming more competitive, like Anthropic's Claude, which they had said we're only going to give to paid subscribers for 5 days, and then they extended it. If you pay for Claude, you've got access to Fable even still, because OpenAI a week later came out with a model that was even better and offered it up to everybody. And so it's getting really competitive. Most of the models are neck and neck with each other, but they're continuously pricing each other down. Which is problematic for the spending commitments they're making, because even on their own internal projections, they think they can start ramping up revenue. That's the projection they're putting out to the market. But they might not be able to do that even if demand does keep up, just because of how competitive it is. And so it's really just profit taking at this stage, even though it was a big sell-off, given how strong a lot of these names are up and where valuations still sit at really elevated levels, it's profit taking. The other thing I'll note, especially with the Korean names, is a lot of those names are bought with really large levels of leverage and leverage ETFs. So that means once these started to unwind, you have the doubling effect. And so the leverage helps you on the way up, but it also hurts you a lot more on the way down, which has a big role to play in the aggressiveness of the sell.
Yeah, I agree. Now, speaking of debt, when you sort of spoke about spending money that they've made, that's one thing. But a lot of these guys are now going into debt to do this. The capital expenditure is being funded by debt, so they're in debt markets. So, it's one thing to spend money you got. It's another thing to spend money that you're borrowing. And I think that's been the big change over the last probably 6 to 12 months. And when you look at the projections, like depending on who you listen to, expected to be about 1 trillion investment, in the next 12 months. If most of that's on the tick or a lot of it's on the tick, it's going to be interesting, I reckon. If they can't get the revenue to meet those obligations, and China seems to have a bit of a strategy to undermine whatever the US are doing. So it's going to be interesting. All right. So from a portfolio perspective, Clint, what are some of the changes that we've made over the last quarter with regard to some of the strategies?
Okay, biggest change we've made is in that fixed interest space. We've exited JCB Dynamic Alpha. Just wasn't performing the way we wanted to, giving us the returns we wanted. And remembering the strategic fixed interest exposure is trying to generate a higher yield than normal, maybe taking a little bit of extra risk in there. We've added the Colchester Emerging Markets Bond Fund. So that's gone into strategic fixed interest over the last little bit, and also into the fixed interest component in the majority of the diversified portfolios. Just trying to generate a bit better yield out of that fixed interest sector against the 3% or whatever that JCB was giving us. Current yield on Colchester is a bit over 7% at the moment. So, that's all.
So just on that, Clint, like that was, emerging market debt. That was, I guess, sort of new territory for us. Jayden, I might get you to just sort of talk about some of the things that we sort of contemplated as we were sort of adding that to the portfolio.
Yeah, so some of the things we're considering the way we blend and what was going to be additive to the existing names in the portfolio, and EM debt provides a big differentiation point. It's a nice diversifier because the drivers there are very different. And so we could have gone with something. So Colchester has another product which isn't EM focused, the Global Bond Fund, which includes EM. Colchester is very focused on real returns. So they forecast inflation for every country and then use that to feed on the real yield and real currency return. And so we could have gone with a broader mandate. EM, we felt, provided an attractive risk return today. So EM markets continue to get more and more sophisticated, and today the yield is commensurate with the risk there. And so even if you look at some of the developed markets, I know Lazard has a pitch at the moment that the US is the new emerging market because of how high their debt levels are and how it just continues to grow without any regard for the long-term impact. And it'll be a problem one day, but it's not for this generation, so don't worry about it. Whereas emerging markets can't afford to do that. And so by not buying a global mandate where they're forced to buy a massive amount of US, you provide real differentiation in the return drives of the portfolio.
Cool. Well, I didn't go as far to say that the US can't afford to do that either. But anyway, so Clint, what else have we been up to?
Yeah, so we think that one's pretty good. Add a little bit more into that fixed interest exposures. Other major change that we've done recently is we've exited the Vanguard International Fund, which was a hedged version, and we've moved that into the Capital Group New Perspectives Fund. So that one wasn't in all the portfolios. International Growth and Giroa Growth was the exposures that we've started to instigate that change coming through.
So Jayden, you might just talk us through the rationale behind the switch from the Vanguard to the Capital Group for the international investments.
Yeah, so on the reason we're switching out of Vanguard, passive is becoming an increasingly hard place to be, especially global passive, because it's largely now a bet on the US and on AI. And so we're increasingly looking at active managers, sometimes with tighter tracking error constraints. So we're not moving too far from the index with a core holding like this. And Capital Group has a tracking error constraint. And so it's not going to be too far from the index, but it will be further enough away that it doesn't become an explicit bet on passive flows to US large tech companies. And so Capital Group New Perspective is a unique fund in that, especially when it was set up, in that it only can buy a company if it generates 25% of its revenue outside of its home region. And so it's basically buying companies that operate globally and aren't just focused on a single region. The Capital Group's also got a unique structure in that it has a multi-portfolio manager structure. So there's 10 portfolio managers on this product. Each manages an individual sleeve, however they want to. And then they're all allocated to by someone who sits over the top. And so they don't know what the other managers have in their sleeve. Nobody does. It's never disclosed. So they're all operating totally independently. And it's one of the few models where this has actually worked out really well. Capital Group also has a unique advantage in terms of its people. And so they have some of the longest tenure investment staff anywhere else in the market and among any of its peers, and some of the most top-notch staff as well. So especially among the PM category, most were analysts for 25 years, and then for 10 to 15 years before that, spent time in industry, whether in high-level science, PhD-level academia research, in the resources industry. They've got all quite incredible backgrounds that aren't pure finance heads for their whole career. So really, a really strong offering in this space in global core equities.
Yeah, we've actually used the capital strategy previously in years gone by, and yeah, the performance was very good. We just changed it for other reasons, which obviously we've come back. Okay, so Clint, in regards to the Adansonia portfolio, there's some pretty major changes that Rick's made to that portfolio, and there's a video that we've just released where Rick's talking us through that. But just you might just summarise briefly for the purpose of this call, what's going on there.
Yeah, so a few people have asked the question because they've noticed some changes in the portfolio there. So I'll leave the full explanation to Rick, so make sure you review that. But the portfolio, he has taken some cash off the table just due to his own concerns there. So there is a higher weighting to cash in that portfolio at the moment. So make sure you watch his portfolio to get a full explanation of that. But yeah, that's just in case the clients ask.
Yeah. Okay. So the other thing in regards to, I guess, I think the momentum strategy is formally launched. So we've executed the first trades in that momentum strategy. So the ASX 100 momentum strategy. So you might just briefly explain to people what that strategy is.
Yeah. So looking at the same sort of strategy, it's now called the Harborside Momentum Strategy. It's the old Australian Share Direct satellite portfolio that was run. The methodology is still the same. There's just been a tilt though these days from smaller cap companies to larger cap companies, just due to trading capacity and stuff like that in that smaller space. So Nick is still doing the same methodology he's always used. It's just a slight change to the market cap that's going to be employed there.
So basically, whilst there's momentum so Nick's out there picking the stocks with the greatest momentum, and then when that momentum turns, he will sell. And he can just go 100% to cash if the momentum goes negative. Yeah.
Yep, correct. Yep.
So from a portfolio perspective, having that alongside of a traditional long-only equity or equity fund or portfolio actually provides correlation benefits, which is obviously one of the reasons why we like that strategy.
Yeah. I will note that you might be getting to it under the new IOD. Nick's got two other strategies that could be quite interesting to people. One is a mixture of that momentum strategy with some international exposure as well, and then the all-weather strategy that I think is going to be quite interesting that I will look to use for my own clients as well.
Yeah, no, absolutely. Now, the other thing I guess we should probably touch on, if we've got any more information, the Dexus infrastructure, talking about making an absolute meal or something. How's that going?
Yeah, so obviously, as we've made everyone aware, we're pretty disappointed with how Dexus have handled this and the closure of their other fund from last year. So this is the old AMP infrastructure fund. We had an update with these guys in June. The slideshow is available on their website if you want to check that out. They are terminating this. They made that decision last October. It unfortunately is going to now push into 2027. That's mainly due to court cases and legal advice in relation to their holding of Melbourne Airport. They are challenging the APAC decision that came out before, and they're not going to get a decision on that until late this year. So that's why it's definitely going to push into 2027. You will see a return of capital from their sale in PowerCo come through, probably this month, I'd say. They're also close to finalising their sale of the Royal Adelaide Hospital, so they'll make another return of capital at that point. They've already paid back 50%. I'm not sure the percentage of PowerCo and Royal Adelaide. And then I think they have about 3 other holdings that are going to still need to be unwound as well. So for those that are asking, that will definitely push into hopefully finalised by financial year 2027, but definitely into 2027 sometime.
Yeah, and we've already got a replacement investment.
Yeah, correct.
For when we get the cash.
Yeah, so people have just noticed a bit of cash sitting there for some time. We've obviously been doing due diligence on a few different things to try and find something a little different than what we already have in there. So we'll get that one implemented shortly to make use of that cash, maybe once we get the money from PowerCo.
Yeah, okay, cool. Okay, so I guess just finally, is there anything else, Clint, that, of note that you think we should be talking about?
No, there hasn't been much else. I think everyone's been asking update on the new hub structure, when they can put extra money, things like that, start new clients up. There's been plenty of emails from Kath and Lisa and co in relation to that. So that all should be now up and running. And if you have any questions around that with the new processes, just reach out to Kath's team and they'll be able to assist you with that. But from the investment side of things, everything seems to be been going pretty well there, Rob.
Okay, no dramas. Well, Clint, Jaden, thanks for joining us, and we'll see you again next quarter.